Good morning and Happy New Year and all that great stuff. Chinese New Year was Sunday. We wanted to figure out great ways for you to save money this year because it is going to be a strong year for us, and we have to be very strong, very conservative with our monies, and we want to save money. And that's the best part about being a realtor is you can save money and hide money like all kinds of interesting places. So Andrea's going to tell you all the legal ways to do that. That's not my job. So without further ado, you've got Andrea.
Good morning. And I did not send you the slides ahead of time, so I will send them over to you. I had a surprise meeting this morning. So slides that are here, let me grab one of my folders. You guys have been in person before with me, so you probably have some of these things already, but I always like to give out our real estate agent tax guide to help those who aren't super great at organizing their tax stuff, to help them. So that is in the folder. I also have our roadmap to resolution because I am a CPA, but I'm also a certified tax resolution specialist. So like fixing tax problems, and those are all the ways we can do it. You of course have your slides, and I have a handout about FERPTA and all that stuff that I don't do, but someone in my office loves to do. So all that info is here. People who are in person have a few goodies. And I was asked to talk today about realtor tax tips, which is a very broad subject. So it would be like if I said, hey, I have someone who wants to know, they have some questions about buying a home. Can you do a presentation for them? So I tried really hard to narrow into what I thought they were asking for. So tell us what we need to know. Yeah, yes. So I don't know who's on Zoom. I know you guys in person know who I am, but I am Andrea Dillon. I am a CPA and, like I said, a certified tax resolution specialist at Noack Co. I am the owner as of July 1st. Thank you. I did go to FGCU locally. I went to a few schools before that, but I wanted to come home. It used to be a nice small town then. I don't know. You guys know what happened, but it's not anymore. So, but I came back here, which is of course where I've started and kept my career. And my office works with a few other areas, but I specifically work in the real estate world right now. I dabble a little bit in construction, which I like to argue is still real estate because it's improving real estate. But that is my agents, investors, flippers, brokers, property managers, but I really like to work with the agents. All right, so I have 5 tips for you. My first tip is and I tried to focus on 2023 going forward and 2022. So getting ready for your taxes, which e-filing opened 2 days ago, yesterday, the 23rd. E-filing opened yesterday. Now, what I don't know is if 2021 you're able to e-file yet because it's been shut down for the last 6-8 weeks. But 2022 can be e-filed. Tax season is open. Are you ready? So if the answer is yes, I have all of my info together. My best advice for you, which is why it's number 1, is to get your info in now. So whoever is doing your taxes, your tax pro, your advisor, I guess if you're doing it yourself, you don't have to get it in anywhere, but is to do it sooner rather than later, because on our end in the tax world, and I know you guys were both here, I believe, for my hurricane loss presentation, there's a lot of stuff happening that's going to take us more time to prepare people's taxes. So people who tend to, and judgmentally speaking, a lot of our agents like to kind of wait until a little bit later because putting your info together is not super fun. I would expect delays because every single tax return we touch, we have to ask everybody about their hurricane damages. So it's going to take longer. So if you wait until really, really close to the deadline or, the end of March to get your info in, you may end up getting an extension when you weren't really wanting to. So if you've got it all ready, just make the appointment and get your info in sooner rather than later. That also, when you get your info in sooner, it allows your tax pro the opportunity to reach out to have conversations about things that you may not know you're missing or you may not know you should be preparing. But when you get really close to the deadline, what we hear a lot is, I don't want an extension. So to us, that means, okay, ask what we need to ask, but get it through. Whereas when you come in sooner and we're not quite as bombarded yet, like we have time to have some of those conversations. If the answer is no, you are not ready yet, get ready. So procrastination costs you money. Just like I said, we hear oftentimes, I really don't want to file an extension, but sometimes it makes more sense to file an extension because you're just trying to push stuff through. So you do kind of haphazard job of getting your stuff ready. Your accountant or your tax pro is already in the weeds and doesn't necessarily, they do the big stuff, they do the best they can, but they can't dive into it like maybe they could if it was earlier or in the summer. So sometimes it actually does make sense if you are not ready to actually file that extension. It gives you a little bit more time and you can have some of those conversations. There are also penalties for not paying with your extension. A lot of people think that they just file an extension and they're good to go. And then when they file their taxes and call it June or July, they get surprised that why do I owe $5,000, but why do I actually have to pay $6,000? And that's because it is an extension to file, not an extension to pay. So that means you are supposed to pay with your extension. Yes. So that therein lies the issue is people go, okay, but if I knew how much I was supposed to pay, like I would be ready to file. So there's a few different ways you can handle it. You can pay based on the prior year. So people who have fairly consistent income levels, probably around what you owed last year, would be similar to what you owed this year. The issue we see in real estate is it's not always consistent depending on how the market goes. It could be up and it could be down. So you can always use your last year or like maybe the last couple of years kind of as a guide so that you can have some kind of info. You can always shoot your accountant and say, look, I'm not ready. Like you don't need to do my return, but my 1099 was for 150 grand this year. Can you give me everything else is the same. Give me a ballpark. And then we can, like what I like to do is kind of just see where your profit margin was last year. Like your expenses are probably the same year over year. So if I know what your 1099 was for and you say like nothing else changed, I didn't sell a house or buy a house or do anything, I can at least be like, hey, this isn't exact, but pay this much. So having that conversation with your tax pro again sooner rather than later, and that will help.
And can you let everybody know on Zoom that it's scanned in the slides so they can find it in the chat?
Oh, good. Okay. Joanna said she scanned in the slides. They're in the chat because I forgot to email them over. So they're there now. Thank you. Okay, so you should have your 1099 now, or maybe it's coming out soon. If you don't have it yet within the next week or so, you will. So that's always the easy part, because what we hear from our agents in line with what she's saying is that, you know, it's not easy to get ready for your taxes. It's not fun to sit down and go through all of your stuff to get ready. So what are the best ways that you can get ready? Obviously, if you're doing something like QuickBooks, then just staying up to date with it. I'll tell you, most of our agents don't use QuickBooks. And when I meet with new agents and they ask me about how they should keep track of their expenses, I don't usually recommend it. I love QuickBooks. I recommend QuickBooks if you're going to use a software. I just don't necessarily think it's necessary because you don't have a ton of expenses. So if you want the ease of a software that will like link to your bank and you can just go in and you know, click. Yep, that's my MLS fees are going to go to dues and subscription. Like you want to have that easy piece. Great. QuickBooks is awesome. However, Excel works fine. So if someone wants to go in every month and kind of just look at their business bank statements and just type out what their expenses are, like Excel is going to be fine for that. And we do, of course, still have our people who give us their handwritten summary. So I did give you the tax guide in the folder, and my advice is always, because it is January right now, so it is the time of year where you can kind of kick off the year right, is to do this every single month. Because if you get in the habit of doing it every month, you have the same costs every month. So it will get easier if you sit down and do it every month, or at the very least quarterly. But what we tend to see is people call us in November and they say, hey, I want to pay an estimate for January. What do I pay? And I go, great, where are you at? Like, what does your income look like? And they go, I don't know. It's all still sitting in my box. I haven't gone through it yet. And so then we have to have kind of like our best guess conversation. So if you can have your stuff in order going throughout the year, it will help you as you're trying to have some conversations with your accountant during the year. All right, next thing, I'm not going deep into this. I don't know how many people were on for it, but number 2 for getting ready or for 2022 tax season tips is get your hurricane damages in line. I did a whole presentation just on this because it's going to be a massive thing that like 98% of our clients are going to have, because probably 98% of Lee County residents had some level of hurricane damages. You could either take those on your 2021 taxes or 2022. Assuming you're taking them when you file your taxes this year, you have to have your stuff together for it. Otherwise, expect a call from your accountant to say, hey, what were they? Things you need to have ready are cost to repair your damages. We're telling people now, we've been telling people for the last 2 months or so, based on like where their damages were, how much they had, is, hey, go ahead and get your estimates and your stuff lined up because I'm going to need that. So if you already have that done now, you start calling like your screen guy and your roofers and stuff and get them out now, then you'll be able to give that to your accountant and then your taxes won't be on hold for that. Estimate. So if you haven't already fixed it, then get estimates to get it fixed. You do not have to fix it for your taxes, but we still need a reasonable number from somebody in that industry to fix it. I'm sure all of the contractors are going to love that. All the people getting estimates for their taxes that aren't really planning on doing anything because they have so much time right now. Insurance claims reports. There may be multiple insurance claims reports we need based on if you've got home insurance, wind insurance, flood insurance. A lot of our Sanibel people or people who had water in the house have filed insurance reports with multiple levels of their insurance. We need all of them. Your car, if you've got car insurance, if you've got personal belongings included in any of those, whatever you filed claims with, we need. Appraisal reports. That means if you did an SBA loan for physical damages and you had the SBA sent their person out to do it, if you have an appraisal report from your insurance, probably covered by your insurance report, but we're starting to see a lot of people now having to bring in the public adjusters and things like that. We need those because if you give me your insurance report and it says you have a $15,000 loss, but you're fighting it and your public adjuster says that it's a $30,000 loss, if all you give me is the 15, that's what you get on your taxes. Would you rather write off 15 or 30? So having all of those things ready for your accountant and having them all submitted in one will give you the best breaks on your taxes so that you don't then have to either go back and amend it or miss out on it, because that's going to be a big thing this year. Writing off the correct amount. I just spoke about that. For example, if your insurance deductible is $7,000, you submit your tax info late and you're in a hurry, as is your tax pro. Your tax pro sees your insurance report, says, great, their deductible was $7,000. Let's write that off. They want to file on time. But your pool cage, we're seeing this a lot, was not included in your insurance. We didn't know about it. And it is an additional $7,000 in aluminum damage, because a tree hit your cage and it needs, call it $6,000, sorry, of aluminum and screen work. You didn't tell your tax pro, they didn't have time to ask because they were in the weeds, and you just lost out on that extra $6,000 for not having that information available. And that would be about $1,200 off your taxes. So trying to get all of that lined up now so that you maximize that. Number 3 is to remember to fund your stuff. So I'm presuming most people know about some of this, but from a top level, I love HSAs. You guys know about HSAs? Yep. HSAs are one of my favorite things in the world. So for anybody who's listening in on Zoom, if you don't know, very just like top level, what is an HSA? It's basically a bank account that you use for medical. That's it. You get a card for it. When I go to the pharmacy to pick up a prescription, I swipe with this card instead of this card. I'm going to pay either way, but this card gives me basically a 20% discount. So that's the one I want to use. So special bank account used for medical, the way it works is when you put money into it, you get to write it off instead of having to spend it and write it off. So if the 2022 HSA limit is, I think it's on the, oh, it's up here. The 2022 HSA limit is $7,300. So that means if I put all $7,300 into that account, but I only spend $3,000 on my medical, I get to write off $7,300 because that's what I funded it with, not the amount that I spent. Now, that means when I then spend said $7,300, I can't write it off because I already wrote it off when I put it in. However, medical is very difficult to write off these days. So most people, unless you are in some kind of like medically assisted living facility where you have like an astronomically high amount of medical, or you had some kind of catastrophe that year, you don't ever get to write off your medical. You cannot, so you can use it for your deductible. So anything that's out of pocket. So what can you use said money for? Anything that your co-pays, your out of pocket pre your deductible, things that you don't have insurance for. So like vision care, dental care, anything you have to go to the pharmacy to pay for. So yes, of course, that's our prescriptions, but like, it's also the really good cold medicines when you're really sick, like you have to go to the pharmacy for those. But if I can just go down aisle 7 and pick it up, it doesn't count. Now, what you can't use it for is insurance premiums. So you can't physically pay the premium with it. You have to pay that out of, I don't know, another account, but not your HSA. You can't use it for the gym. And you can't use it for vitamins. And you can't use it for massages, but the loophole I like to tell people is if your chiropractor offers massages and you're billed through your chiropractor and it's, you know, through their stuff instead of just like Spada, which is wonderful, don't get me wrong. Like, I think that's maybe a little bit of a loophole. But they are wonderful because again, you get to write it off when you put the money in, doesn't necessarily matter if you spend it. And it's a bank account. So whatever your balance is on December 31st, like you still have it January 1st, it's still there. So it's not like a use it or lose it sort of thing, like some of the FSAs and MSAs are like that employers offer. That is not the case. If it keeps, I didn't put this up here, but if it keeps adding, so we have clients who max it out every year. They put the 7,300 a year into it every year. And then maybe like for 5 years in a row, they don't really have anything major. They just have normal copays and stuff. They obviously don't have young children. They can convert to an IRA. So it's not like it forever gets stuck in this account where you have to use it for medical. I mean, you wouldn't want to do it like all the time. You would let it build, but you are able to then convert that to a traditional IRA. Basically, it's 20% off on your medical. That's not a set in stone. You get to write it off. So generally speaking, it saves you about 20%. So again, if I'm going to pay my pediatrician, either way, I would rather pay with a 20% tax discount than not. So they are fantastic.
Andrea, a quick question.
Yes.
Don't you have to have a certain type of health plan to qualify?
You do. I'm sorry, I skipped that piece because I started down here. So in order to qualify for an HSA, you do have to have health insurance. So you're not allowed to not have health insurance. And you do have to have what they say is a high deductible health insurance plan. No, yeah, I don't think it does. No, but the minimum deductibles for the high deductible qualifying plans for 2022 are $1,400 if it's just you and $2,800 if it's for your family. Most people have those deductibles. Very, very, very few people in today's health insurance world have deductibles that are lower than that. So most people, if they've got insurance, they have it. The other thing I do actually tell people is if they have insurance and they have a lower deductible, so if their deductible for like their family instead of $2,800 is, I don't know, call it $1,500. So it's $1,000, call it off. So they can't do the HSA, but they're paying $400 a month more for that plan. Sometimes it makes sense to maybe do the plan that's $400 cheaper and get the HSA. So it depends on case by case basis. And the other wonderful thing about these is that you actually have until April 15th of this year to contribute for last year. So we have lots of people who want to do their taxes and say, tell me what I owe. And then if I need to put money into my HSA or my IRA, because those are the same, I'll do it. But if I don't need to, like if I don't owe anything, I don't want to. So those are always really wonderful. It's kind of like a buffer because you can still do it this year for last year.
Somebody is asking what card is she on?
What card? So like if you get an HSA, because it's a bank account, just like if you went to the bank and opened a bank account, they would give you like a debit card for it. So then when you go to pay, you'll have a debit card, like you're paying with that bank account. So they'll give you a debit card for it. So if that person has an HSA, maybe they just, I don't know who their provider is. Maybe they don't have a card, but I know that I use and I recommend HSA Bank, which is not an actual brick and mortar local bank. It's like an online platform, but that's all they do is HSAs. And I know I have a debit card for mine. And I know that I actually had a brick and mortar bank first, and I didn't like it because I had to keep track of my contributions. And sometimes like that January 1st through April 15th period is hard to remember which year you were contributing for. So with HSA Bank, they make you pick. So if I put money in, I just put money in to pay something last week, and I can't do it without picking the year. So they do a really great job of keeping track of that for you, and you get the debit card. So on the same line of remembering to fund your stuff, of course, we've got IRAs as well that you also have until April 15th to fund. So that's the other thing that people like to float is they do their taxes, get all their numbers lined up, and then say, tell me what I need to contribute. So just in case people online don't know the details, because we get these questions a lot. What's the difference between a Roth and a traditional? Roth means that you're paying the taxes now. And so you're not writing it off. And then when you retire and you pull from said account, you're paying tax on it. Whereas a traditional IRA, you are putting it into your account now and you're writing it off now. But when you retire, that's taxable. What we actually like to see, so which one to use, it really depends on your income. But a lot of agents have both. And depending on their year, they'll pick which one to fund. So if somebody has like a mediocre year, to a down year, it may make sense to do the Roth because you're not in a high tax bracket this year. So pay the tax, and then you've got that account for when you retire that you sometimes build on that's tax free. But if you had a really, really strong year, like a lot of our agents did in 2020, 2021, they were using their traditional because they were in a really high tax bracket. So it made more sense to fund the one that you could write it off now, because likely when you retire, you won't be in a tax bracket that high. So if they don't have something more formal set up, that tends to be what we see is they kind of have both. And then depending on how they go, different years, it makes sense to contribute to different ones. Now, the max to fund for 2022 is 6,000. I don't think that's changed in a while. It always hovers around there. That's another one you have until April 15th to fund. And the only thing I like to I don't want to highlight it, but I do want to say it, is if you have another job, or if your spouse has a job and there's a 401k offered through their job, there's rules on that. And if you made a lot of money, there's rules on that. So if you are over these limits, if you file on your own and you made profits, not 1099, of 129 or higher, or if you're married and your household income is about 200 grand or higher, before you just go dropping money into that thinking you're going to write it off, you might want to call your tax pro and make sure that you actually could, because sometimes it gets backed out and you thought you were writing something off. Now you're out the money and you didn't get the tax write-off. SEP IRAs. I don't always love SEP IRAs. They do work well in the real estate world though. So I did want to talk about those. These are IRAs that are, instead of being in your personal name, they're in your business name. So if you've got Andrea Dillon LLC that you're operating under, the SEP IRA is in my LLC name, not in my personal name. Now, these give you a much higher contribution limit. Well, depending on your profit, they give you a much higher contribution limit, because whereas the normal IRAs, you've got that $6,000 limit. These, it's 25% of your profit with a max of 61 grand. So if your profit is only 10 grand, obviously that's not going to be higher. 25% of 10 grand is less than 6,000. But if you're making real money, this is typically going to allow you to put more money away. You also have until April 15th, unless you file an extension, and then you actually have all the way until you file your taxes. So if that's either September or October, depending on your entity type, that gives you a lot more time. So again, it gives you a little bit of time to see where your taxes lie. And then if you had a really great year, you can actually shovel a whole bunch of it into your SEP IRA. Now, these are important. I'm not going to dwell on it because it's really not your world. But if you have employees, which most agents don't, you might have like a contractor who helps you from time to time. That doesn't count. If you have a W-2 employee, whatever you do for you, you have to do for them. So like our construction guys, this doesn't work well for, because just because the owner wants to put 25% away for him, he probably doesn't want to put 25% away for his employees. That's a really big amount. But for you guys, it works wonderfully because your business model is that you don't typically have employees other than like yourself. Okay, so as an example, Sally Seller made 90 grand in profit in her real estate business last year. Her husband also worked, but he didn't make enough to have any of those income phase out issues that we talked about. So we're just going to assume they qualify, right? She wants to max out her retirement contributions. So if she does just a regular traditional IRA, her maximum contribution is going to be the 6 grand. She's got until April 15th to do it. And it's going to save her, call it $900, give or take a few hundred, depending on like her taxes. If she does the SEP, same earnings, 25% of her 90 grand is her max. So she's allowed to put all the way up to 22,500 in it. So it gives her a lot more she can fund into her retirement. She has until, assuming she's filing on her personal taxes, she has until October 15th to do this, as long as she filed an extension. If you don't file your extension, that doesn't count. And that would save her roughly $3,300 in taxes. So she can put more in and she can save more in taxes, but you have to have the money to be able to do that. So it doesn't do any good if you don't have 20 grand that you're comfortable throwing into this account. And a lot of this depends, which we'll get to in a few, I think number 5, is it depends on what your goals are. Because depending on where you're at in your life, you have different things that are important to you. So somebody who maybe just quit their full-time job, they're 28 and they're still trying to pay their bills, this is probably not going to be their biggest concern at the moment. But I worked with an agent last year to max out some of these things who was 66 and her husband had just retired from a very high-end banking job, and their goal was max out everything we can for retirement because we're starting to exit plan from our careers and whatnot. So it all depends on what your goals are. There are other things you can fund. I mean, there's simple IRAs, there's solo IRA or solo 401ks. There's like just a traditional safe harbor 401ks. These tend to have higher fees, depending on the complexity, but some of them let you put more away. So if you're doing the SEP and it's still not enough, we have an agent who did set up a solo 401k, I believe, last year, and she's able to put, with all the stuff the advisors do, I think she was able to put away like 67,000 last year. So if you want to put more away, there's other options. All right, number 4 is, and I'll try to go through this one quickly because I know it's already been, I thought this was going to be a fast presentation. Is get your number 5 is quick, I promise. Number 4, get your auto in order, which to my agents, if you're going to pick one area to be very diligent, is your auto, because it's the biggest audited that we see, in my opinion. It's the biggest audited area, and it is typically your biggest expense. So if you're going to pick one area to be like on the ball for, this is it. So mileage versus actual, in a nutshell, I'm presuming you guys know most of this. You get to pick, you can't take both, otherwise you're double dipping. You can either take your actual cost, your gas, your insurance, your maintenance, your repairs, your lease payments, like your physical cost of driving said vehicle, or you can take the mileage rate, which the IRS determines every year, and it like is, call it a national standard that includes those, which is why you can't do both. So 2022, not that you guys need to know this unless you're filing your own taxes. They did this, I don't know how many years ago, 3 or 4 years ago. It's really annoying when they do it, but they did it again this year because of the rising costs during the year. Is they did a split year. So they did the normal up. So January 1st through June 30th, the mileage rate is 58.5 cents per mile. And then they upped it to 62.5 for the second half of the year. So if you are doing your own taxes, make sure you're aware there's a split for that. And it's just because costs raised so fast. All right, so what you did not see on that list was my car payment. That is because if your business does not own your vehicle, if Andrea Dillon LLC does not own my car, my business can't write it off. It's not my business doesn't own it. It can't write off something it doesn't own. And we see that all the time as wrong, where somebody owns it personally, they use it for business and they want to write it off on their business. Tax code is very clear on this. There's a lot of preparers that do things differently, but we are very, very strict on this. You got to do it right. Your business can't write off an asset it doesn't own. So if you want to write it off, sign it over to your business. If you sign it off to, or you sign it over to your business, keep in mind your insurance is going to go up because now you have a commercial vehicle. So make sure you're calling your insurance agent first to make sure that it makes sense. It depends on your car. So typically for the agents, it's not a big deal. It's our construction guys that. Yep, there you go. And the other thing I always tell people to consider is how much is the car? So if it's a car that you already own and it's only worth 15 grand, by the time you pay for, the retitling fees and the taxes on that, the registration and the commercial insurance, like, is it really worth it? But if you're going out and you're buying a $60,000 car, probably going to make sense. So having those conversations with your tax pro before you're doing it is always important. Every single year, we have a few people who go, I know that you told me I have to do it in my business name, but when I went to the dealer, they said they didn't want to lend to me. So I just did it in my personal name. And we go, that's great. But I told you, you can't do that. So unless you want to retitle it over, there's nothing I can do. Your business doesn't own it.
Question.
Yes.
I know sometimes the IRS has wonderful little goodies about certain types of cars that you can purchase and all of that. Is there anything going on for 2023? I know there was one for 2022.
No, so the main thing that they've done that I'm aware of is obviously if you buy a vehicle and you want to write the whole thing off, it has to be over 6,000 pounds. So if you buy a $50,000 Chevy Tahoe and you had a really good year and you want to write all $50,000 off this, call it 2022, but this year, then it has to be over 6,000 pounds. Otherwise you get limited based off the type of car. There's like a standard sedan amount, and then there's like a mid-size, and then there's the heavy vehicles. So the dealers know that if you go in and you say, I want to, like, it has to be a weight limit, they're going to know that 6,000. I don't know of anything about that, but what I do know, which is not in my presentation today, is about the electric vehicle credits. So, and I'm going on memory on this one, so my numbers may not be exactly right. This was actually all the electric credits. So like the solar credits, which is probably a whole presentation in and of itself, was my most frequently asked question. I'm sure you guys get this on the sales side too, before the hurricane. So I think I had like 5 people call in the first 2 or 3 weeks of September asking, which is a lot, asking about this one reform, because the reform happened, I think, in August for the solar, like all the changes that they made for the solar tax credits. So I did a whole bunch of research on it, and then the hurricane hit and all of those calls went away. So everybody was more worried about the problems from the hurricane. So what I can tell you is for the cars, and I believe it doesn't start till this year, which, I mean, you can't go back and buy one last year anyways, but I believe as of January 1st, 2023, the solar tax credit, whereas you used to have to buy a brand new car to qualify, you're actually able to buy a used solar car or electric car, EV car, and qualify. But I think you have to be the second owner. So I could buy it from you and I would count. But if I then sold it to Joanna, she's the third owner, she doesn't get it. Now, the other really important thing there is a list. I don't have said list. If I could, I'm sure it's available on Google, of which cars count, because the way that they do it, which is completely stupid, is when the manufacturer hits a certain like amount of cars sold, the credit goes away. So like the more popular cars, Teslas that everybody wants to buy, that credit has been gone for years. I think it stopped 2 years ago, like they hit that sales limit, but the ones that are either like newly coming out or just aren't as popular, they haven't hit those limits yet. So the credit is still available. The dealers should know that. And I would imagine that that has to regularly be updated because cars sell every day. So that number is constantly changing. Now, the other new thing for 2022 on those is, and again, I don't have the numbers off the top of my head, but there is an income limitation now, and it's not that high. I do remember that when I did my training on it, was that if you wanted to qualify for the credit for the cars, then, and I can't remember how much the credit is, call it maybe around $3,000 or so, give or take for the car. But if you wanted to qualify and you make too much money, you don't qualify. And the income amount is somewhere in the hundreds, like 100 something, like it wasn't like 300 grand or 250, like it wasn't that high. Because I remember seeing it and going, well, gosh, like that's like half our clients aren't going to qualify, probably more than that. So there's definitely some planning involved on what year might be the best year to do that. But there's a lot happening in the solar world because there's a solar tax credits and all that stuff too. So
We have a question in the chat. It says, what about a lease in your personal name?
So leases actually give you a lot more flexibility. So your options obviously are to lease a car or to buy a car. If you buy a car, like I said, has to be in your business name. If it's not, then not to say there's not lots of people, we see it wrong all the time, that will let you write it off. But I mean, it is wrong. It's very clear in the tax code. If you lease a car, you can lease it in your personal name, which actually usually gives you like better deals from the dealer. They always want the people to lease them. Insurance will be cheaper. And what we can do is we can take a percentage of your lease payment. So we can't take 100% because again, it's in your personal name, but we can take like 90 or 95%. Like we can take a high percent if that is truly what you're using it for business, which most of our realtors do. You use your car for business all the time. So it gives you a little bit more flexibility because you're not trying to say, hey, I own this car. In essence, you're paying to borrow it. So it's like a rental fee. Exactly. It's not an asset at all. So it'll go in a different spot on your taxes. You'll see the lease payments separated out. And as long as we don't take 100% and you can actually support, which we'll get to, that it is used for business, then it gives you a little bit more flexibility. Now, the flip side to that is, and I don't know the details on it, but leases can sometimes not be favorable for realtors because you drive so much. So depending on like how their mileage rates and stuff are, and how much you drive. I mean, we have some agents who sell exclusively on Sanibel, which didn't go so well last year. Yeah, so like they leased because they didn't have to, like it saved them money to do it that way. And they really didn't drive very much. But someone who's doing all of Lee County, depends on your driving. Did I answer the question? All good? I think so. Okay, so if you use miles, how do you track them? We are a great time of year for this because it's January. So I love Mile IQ. It's a little app on your phone. You just swipe. You do have to pay for it. I think it's like $5 a month. If either of you use it, maybe you know.
Like $60.
Yeah, so something in that fee stops it from draining data on your phone. That's all I know. There's lots of free ones, but everybody tells us it kills their data and then they don't use it. So my opinion is pay the $5. You get to write it off.
What's the program again? So they can-
Mile IQ, like your IQ, your smarts. Now, we do have people who want to do pen and paper, and they just like keep a notebook in their glove compartment or whatever, and that's fine. Things that we need to know are like, so like the headings for your list are going to be the date, beginning odometer, ending odometer, and something for why it was business. Like it can be my name and I'm a client. So Andrea Dillon, it can be, you know, the office, if you went to the office for something, but like something that'll jog your memory if you were to be audited as to why that was business. Now, the thing that we see all the time, and again, this is a perfect time of year for it, is the IRS always wants to see third-party verification. Whether you're using actual or you're using miles for some idiotic reason, they want to see third-party verification. And if you can't provide it, they like to disallow stuff. So what that means is you have an invoice from your mechanic that has the miles written on it. It does not mean you snapped a photo of your mileage, your odometer at the end of the year, because that's you taking the photo. So what I like to tell people is get in the habit now, it's January. Every January, take your car in for something, a tune-up, an oil change, something. Take it in for something. Because if you do that every single January, now you have your third-party verification. People tend to just take it in. I mean, I do the same thing. People tend to take it, but I'm not writing my miles down. People tend to take it in when there's a problem, right? So then they get audited and I say, hey, reach out to your mechanic and send me any invoices you have that year because it's going to have the odometer readings. And they typically give me like March and like October. So like I can support 6 months of miles, but not the rest of the year. So if you do it every January, get in the habit of that. Now we have a third-party verification every single year. So example, Alex agent drove 20,000 miles last year and wrote him off on his taxes. He got audited. The IRS asked for the third-party verification in addition to his mileage log, which they will always ask for. He only took his car in one time during the year, and it was in the summer. So couldn't support the whole year's miles. The IRS disallowed some of his miles because he could not show that he didn't make up his entire mileage log, that those miles actually transpired. And that happens a lot. So again, I already spoke about that. My fix, take your car in once a year in like either December or January. We're in January, so. All right, number 5, my last tip is for your taxes this year, is to plan for next year because we are already in next year. Like taxes tend to lag behind. So people who are not proactively thinking, if you're right now thinking about your 2022 taxes, which everybody is, now we're not thinking about 2023 and our extenders, we like to wait until there's probably people listening in who haven't yet filed 2021 because of the extension for that. So now we're 2 years behind. So how do we plan for 2023 to save you money this year and to line up with what your financial goals are this year when we're thinking about 2021? You can't. So trying to set yourself up to be forward facing instead of continuing to be stressed out and behind. I know it's not fun. I actually I had to have some dental work done this past, I don't know, November. And I hate the dentist. And I was sitting in the chair and I was like, this is probably how people feel when they come in to see me. So I understand. So things that you can do to plan for next year. Pay your taxes. Sometimes easier said than done. I actually worked with a client once who hadn't filed or paid his taxes in 25 years. Now you don't have to file all those to catch up, but still it was 25 years. So pay what you can by the extension date, pay the rest when you're filing. We talked about that is how do I know if I'm not ready to file, how do I know what to pay? If you can't pay and that's what's holding you up, you're going to owe roughly what you owed last year. Maybe it was 30 grand and you go, well, I don't have it. Like I had to repair my house while I was waiting on insurance. I spent it. Still file and set up a payment plan. And then as you can, you'll take care of it. That is the cheapest way to do it because you still owe the taxes even if you don't file. That just means you're kicking that can down the road and it's going to be more expensive because you're going to have late filing fees, penalties, interest, all kinds of stuff on top of what you owe. If you can't file because you can't get your numbers together, because you just don't have the time, you're so busy selling properties and listing properties that you don't have the time to sit down and go through all your year's worth of receipts because you didn't do it every month, pay someone to help you. It doesn't have to be a CPA going through your receipts. There's lots of people out there that can just help you organize them and just create a spreadsheet for you to help you so that you can move forward and not have that hanging over your head as something else on your to-do list. Yes.
The bad side of it, with all these hurricanes, a lot of people actually lost.
They
their
did.
physical
They did.
What can they do?
The easiest thing they're going to be able to do, at least for you guys, like in the real estate world, because you don't have like big supply houses where like you can reach out and get those, is looking at your bank and credit card statements. So it's gonna, so typically the IRS does not accept a bank statement as proof. Like if you get audited and you say, well, here, I created all of my accounting from, here's my business bank statements. They're going to go, that's great. Give me the receipts. And you either have them or you don't. In cases like this, I would like to, we haven't had something this drastic that I can in my lifetime in Lee County, but I would like to think that they would be more willing to work with someone. So I would do the best you can. And then I would say, make sure with your tax documents, you have go ahead and just type it out in Word or write it out and scan it and stick it in your tax folder. So there's record of it, why you don't have your receipts. My house got flooded. My garage got flooded. Like whatever happened, so that then, and date that, so that then because the IRS audits lag behind. So if in 2 to 3 years you get audited, you have that written down. You've got your insurance claim that hopefully shows that. You've got the hurricane damages on your tax return to support it. And that's all you can do. Pay your 2023 estimates. The first one is due April 15th. Yes, that's the day your 2022 taxes are due. But if you're paying quarterly, that means you're full paid. I know everybody is doing that by the time you file your taxes. But trying to stop the snowball effect, which I'll talk about in a minute, getting ahead by trying to pay your 2023 taxes so that you're not stressed out all during the year. If you don't have enough money to do both, you cannot pay your 2022 tax bill, possibly 2021 tax bill, 2022 tax bill, and pay your Q1 estimate for 2023. What I always tell people to do, case by case, but generally speaking, what I always tell people to do is to pay your Q1 estimate for 2023 and set up a payment plan for the rest, because you can chip away at that as you have, great months or whatever, and you're able to knock that away. But what we tend to see is people freak out and they pay off the back bill or the most of it, whatever they can, but then they just spend all their cash so that they're comfortable spending. So now they can't pay going forward. So then that means when 2023 is due, we have the same problem. And that's the snowball effect. Is I owed for 2021, I paid it, but then I couldn't pay my 2022 estimates. So I figured I'd just wait till I filed. I owed again, and I couldn't pay all of it because I used all my money for 2021. So I paid what I could, and then I left a balance due. But I couldn't pay any of my estimates because I just drained all my savings for that. 2023, I think I'm going to owe again, because you all, if you're making money, you probably owe. I I still can't pay my estimates because I used all my cash to pay 2022. Plus I still owe for 2022. And now I'm going to owe for 2023. That's the snowball effect. We want to stop that. So payment plan for old taxes. IRS is usually very willing to work with you on those. Fix it going forward so that that goes away and you're on a good path. Actually connect with your tax pro about 2023 during 2023. There are oftentimes electric vehicle credits, things like that, that come up during the year that on March 17th, we may not have time to sit down and chit chat with you about your vehicle options and what you qualify for. But in June, we do. In November, we do. And these are things that can help you save money. We need to be aware of what your goals are. If your plan is, hey, I want to buy my first home, I want to buy my first investment home. These are all things that require you to have income. So if you give us everything and you write off everything under the sun that you're legally able to, and it takes away all your income, and then in 3 months you go try to get approved for a loan and you can't do it, and you call us up and you say, what do I do? Well, we really should have known that when we filed your taxes, because we might not have been as aggressive in some areas. Yeah, you'd have to pay some tax, but then you could move forward with your goals. There's all kinds of things that we should be aware of. Hey, my goals are that I want to start splitting time between here and Georgia, and what do I need to do in my taxes so that I can get myself set up for that? You could be the wrong entity type. Whole meeting in and of itself of should I be an LLC or should I be a PA? How do I file my taxes? We see that all the time. You could be missing out on things because you don't understand them and you're not connecting during the year. Payroll is a big thing. Overpaying yourself and costing yourself tons of money. You could be screwing up your goals instead of setting yourself up for them. These are all things that are really important to make sure that your taxes all line up with. And that is that. I thought it would only be like 20 minutes, but here we are 47 minutes later. So, does anybody have any questions for me? I think we're good. We've kind of just been going as we go.
And you can make charitable deductions still.
Yep, you sure can. Mhm.
So that leads me into Pause for Cause for Cape Coral Animal Shelter. They do medical, they do adoptions, they do education and training. They really help save little cats and dogs and things like that. They're having a fundraiser. So if you want to give any kind of a donation at all, you can put your name on a little paw. There'll be a huge party in February, which we'll keep you posted on.
Let me know about that too.
I will.
We
Yeah,
are dog
so
people in my office.
Pause, we are too. Pause for a Cause fundraiser. So, and if you're not in the office, stop by, tell us, we'll take your money anyway. Yeah. All right. If you don't have any questions of Andrea, we will send you out, or if you haven't downloaded the 5 tips, we'll do that. We'll leave some folders here so that you can pick them up at the Fort Myers office and use her, because you need to use an accountant, whether it's Andrea or somebody. You can save yourself money by using a professional, just like we tell our for sale by owners, don't do it yourself, use a professional. So remember that. All right. And we'll see you Thursday on Zoom for using marketing stats, which is free to make more money. So without further ado, our famous 2023. Peace out.
And thank you guys for having me.
Thank you. Cool.